bear markets. How long do they last? In order to financially be considered in a bear market, stocks must close 20% below their most recent highs. The recent stock market performance clearly puts us in one. The question then on every investor's lips is, how long will this bear market last? No one can truly answer this question. Sure, analysts will make projections or educated guesses, but those forecasts will cover every scenario imaginable, from a swift, painless recovery to a protracted downturn unlike anything we've ever seen. However, history suggests that the current bear market will probably fall somewhere in between those two extremes. The S&P 500 has lost more than 20% of its value 11 times since 1950. According to a recent analysis from Yardeni Research, the bear market in the early 2000s took 929 days to reach its low point. That equates to roughly 2.5 years. After the incredible rise in internet stock prices in the late 1990s, there was a bear market. The second largest bear market, which began in 1973, ended 630 days after it has begun. Inflation, sluggish economic growth, and the political unrest around United States President Nixon all contributed to a collapse in share prices. Before equities began to rise once more during the early 1980s bear market, 622 days had passed. Here too, inflation played a part. The federal funds rate was aggressively increased by the Fed to a whopping 20% in an effort to combat increasing costs. The result was a recession and significant unemployment. The 2020 slump brought on by shutdowns and anxiety connected to the pandemic was the shortest bear market in history. Share prices fell only for 33 days before they returned to their upward march. Without taking into account the present cycle, bear markets typically last 388 days or just over a year. The average length of a bear market is almost exactly 1 year, excluding the two longest and shortest bear markets, which occurred in 2000 and 2020 respectively. There have only been 3 bear markets since 2000, not counting the current one. 2 of the 3 have outlasted the typical duration of 1 year. The fact that bear markets have invariably given way to bull markets is arguably the most important lesson history can teach us. You'll be in a good position for significant returns if you can postpone selling out of your holdings, or, even better, continue investing during the slump. It is undoubtedly emotionally difficult to keep investing during a bear market, but you may make minor adjustments to your strategy to make it less difficult. For instance, you could temporarily raise your emergency funds deposits if your cash savings are low. When share prices are down, having an additional liquidity cushion can prevent you from making withdrawals from your portfolio. More so than in the past, you might be more inclined toward dividend stocks. You will value the consistency during a weak market, whether you choose to reinvest your dividends or simply cash them out. You could reconsider how much risk you can take. The market has been robust for years, with the exception of blips in 2018 and 2020. In bull markets, it can be difficult to determine how much risk you can take on. In bear markets, this is the time to seriously make that assessment. By adding more conservative, blue-chip positions, you can gradually reduce risk if your investments are more aggressive than you'd like. For investors, bear markets are never comfortable. Fortunately, history has shown that they are also temporary. You can endure this cycle and preserve your portfolio, frequently without making any changes to your investing strategy. If you must change, do the adjustments gradually. If you can, stay away from significant reallocations and panic sales. It will prove worthwhile to be patient because there should be another bull market in the near future, and you want to position yourself to take advantage of significant rebound gains. The US stock market experienced a more than 60% decline between 2007 and 2009 during the financial crisis. Bear markets typically shed between 10 and 20% of their market value, and the one that ended in March 2020 was brief. Through 2021, stocks recovered and maintained their strength. Recessions and bear markets frequently coexist, with the most recent one occurring during the 2008 financial crisis. Only 3 bear markets have not been accompanied by recessions since 1928, compared to the 14 that have. The longest and most severe bear market, which lasted for more than 3 years, was that between 1929 and 1932. The worst bear market was also started by the Great Depression. The market had its shortest bear market ever during the COVID-19 crisis. The S&P 500 didn't reach 20% for nearly 164 days. In contrast to the one that came before the 2008 to 2009 recession, this bear market was much shorter in duration. The 2000 to 2002 tech crash bear market lasted for more than 30 months. From an economic perspective, concerning when a bear market might end, there are 3 key factors that are at play. Number 1, when the market can look past a recession. Number 2, when the Fed starts to ease rate hikes. Number 3, when inflation expectations start to moderate, the bear market will likely ease. It's crucial to keep in mind that the market is fairly forward-looking and that the stock market frequently bottoms out before the economy, and that many Fed rate hikes are also factored into prices. Although it's obvious that the data is confusing, a lot of it is actually rather hopeful. First off, the economy is doing remarkably well on many criteria, including jobs, even though it may be beginning to decline. This implies that any recession, should it occur, may only be minor. Of course, inflation is the main issue, but even here, there is some evidence that suggests we may have already reached the peak core inflation earlier in 2022, especially given that energy prices currently seem to be declining even though inflation is still significantly higher than what policymakers aim for. The market has already factored in numerous Fed rate hikes in the future, but the Fed may decide to adopt a less aggressive strategy. At the most recent Fed meeting, for instance, one policymaker advocated for a lesser increase. Finally, if a recession does occur in 2023, it is possible that the market would bottom out earlier, possibly in 2022. Because the market has already factored in so much terrible economic data, the economy may actually perform slightly better than expected, which might put a floor under the bear market. Of course, everything depends on upcoming economic data and Fed statements, but if the incremental news keeps getting better going forward, the markets are likely to follow suit. That's not really much of a forecast for the economy, other than to state that things currently look bleak and we would need to see much more improvement in the economic data. So, in this bear market, taking into account a variety of elements offers a certain amount of reassurance. Despite the possibility of more stock price losses, it's possible that the worst of this bear market has already occurred. Stocks may still be an appealing asset class going forward, relatively speaking, as has been the case for much of stock market history for those with a long-term investment horizon. Of course, a lot depends on the economy, but even if a recession occurs, it might be rather light because a lot of negative news has already been factored in. Finally, keep in mind that market timing is challenging. Over time, stocks have produced strong returns, and investors who have changed direction due to a down market have frequently fared poorly and missed out on potential future returns.